Well, I would start by pointing to the fact that we've used the word restrictive in terms of how policy we now think is operating. By the way, I mean, in a sense, it's interesting that both the Federal Reserve and the ECB have used the same word as well in the last few weeks as well. And I think we're all in the same place, really, that we're now seeing, because monetary policy always operates with a lag, that effect of policy coming through. And that's good, because we were obviously hoping and expecting that would happen. So that's the starting point for the change. The next thing I'd highlight is that there are, obviously our job and our commitment is to get inflation down to the 2% target. I'm encouraged by the fact that we've seen now quite a decisive move in inflation, and I expect more to come this year. The question for us now, of course, is what's the path from here? Now, we remain evidence-driven. We will look at the evidence again next time we meet. But I've emphasised the point today that there are of course, many potential paths from here to there, to the target, to the 2% target, that is. And I don't want, in any sense, people to think, we've got one in mind. We point to two in the report. One is to follow the market curve, which goes further up and then comes down again. The other one is what we call the constant rate profile, which obviously keeps it at where it is today. Both of those lead us back to target, actually, at around the same time frame, interestingly.
As other central banks got into restrictive territory, some of them have decided to pause or skip meetings. Is that something that you would consider doing as well, to give yourselves more time to assess the data?
The question for us is that we've seen some quite big surprises in recent months. So if you go back to our June meeting, the previous one, we obviously saw some, frankly, unwelcome surprises in terms of inflation and particularly the pay numbers in the labour market. We then had a much better inflation number. So I'm being more cautious because, frankly, we are still seeing some surprises in the news, and I think we need to get ourselves onto a more settled path.
So for now, every meeting still could be a live meeting?
Every meeting is a live meeting in that sense, yes. The decision is it always is in a way, really, because every meeting we have new evidence and we take the decision based on that.
As services inflation is running at 7.2%, do you have a view on where that number should be in order for you to feel satisfied that the economy is on the right track and price stability is on the right track?
Well, it's an important number for a number of reasons. Obviously, it's quite a big component of inflation to start with. Secondly, of course, it does tend to have a much greater labour content in it, and so there is an important link there to pay. What I would caution with the UK's recent services numbers is it's obviously well above a number that's consistent with the target. We've had to sort of pick over the evidence quite carefully because one part of the services number suggests persistence. The other part of the increase, and particularly the increase over where we expected it to be, had a bunch of rather sort of, not particularly sort of persistent-like things in it. Airfares, for instance, vehicle excise duty, all of which we think may be more temporary than services, if there's a norm with services inflation. So again, we'll be watching that very carefully to see what happens. So I'm a bit careful about how much of a signal we take from this.